Hi, I'm Steele, Lorenz, Head of Sustainable Business at FBN, and here with me today is Devin Lammers, CEO of Gradable, which is our sustainability arm, and President of Crop Marketing and Financial Services. Today, we are going to be talking with you about our new carbon program from Gradable, and specifically about the optionality that you have to sell credits either into the offset market or to participate in supply chain programs. So Devin, welcome.
Thanks. Hi, everyone. Hey, Steele.
So first of all, I want to know more about what Gradable Carbon is. Can you give me an overview?
Yeah, so this is our foray into the carbon offset market. And so if folks aren't familiar with how this works, basically what we're trying to figure out is how really agricultural soils act as a sponge for carbon, how you actually extract that from the atmosphere and can store that long-term in soils. And so there are a litany of kind of research and models that have been developed here over many years. And what we're trying to do is figure out how we piece together these programs, incentivize practice for the farmers, and ultimately create credits that corporations can buy to offset their own environmental footprints.
Great, awesome. And so I'm really curious to talk about the second of our three main pillars about why we're different, and that's the optionality to allow growers to sell into the offset market, but then also the work that we're doing in the supply chains and why it's important for growers to be able to pick and choose where their environmental claims end up.
Yeah, so I'll say a couple things. I've said this before, this space is pretty messy and it's still emerging. And part of the reason it's still emerging is because I think everyone is trying to understand what the willingness to pay is for these types of programs, sustainability in general. Is it the private sector, is it the public sector, is it consumers? And we're starting to see some dollars honestly flow into this, but we're talking about millions of dollars. Whereas really to see the impacts that we need long-term, it needs to be billions or tens of billions of dollars. And so what's important for us in terms of optionality is as these markets emerge, farmers really need the flexibility to figure out where the best opportunities are from today. And if those change, which they frankly likely will, be able to migrate to the opportunities that make the most sense for them from a business perspective and a return perspective.
Yeah, great. Now, I am curious to know more about some of the supply chain programs that FBN has built already and what we expect to see in the future.
Yeah, where to start? We run a few large scale programs today with certainly some household brands like Tyson Foods and Unilever. Also with some large biofuel producers. Probably the most important one is Poet Ethanol, which is the largest biorefinery in the world. And so each of these is really trying to ask the question of how these entities start to invest in their own supply chains to drive sustainability. And sustainability means a couple things. It means sustainability at the farm level from an environmental standpoint, but also means supporting kind of the long-term economic outcomes for farms generally. And so ultimately this will require investments in numerous areas. One is trying to figure out how just information is collected at the farm level and in a very low cost, easy way. And this includes a massive amount of information. It can include practice information, application data like the amount of fertilizers or other inputs that are applied to those fields. It could be soil samples, satellite imagery, et cetera. And figure out how to combine that all together into a scoring mechanism or some sort of certification. So that's sort of step one. Step two is how you actually assign that attribute to the grain itself, the physical bushel, and then start to move that through the supply chain. So if for those who aren't very familiar with the value chain of ag, goes maybe from the farmer to the initial grain buyer, to maybe another grain buyer, to maybe another grain buyer, to ultimately probably a processor or a feedlot or a feed operation of some sort, and then ultimately to kind of the end manufacturer where it gets shipped out to the shelves. And so trying to make sure we understand how that information is going to be easily conveyed through all those steps in the value chain is really important and challenging. And then ultimately, again, kind of who makes investments in those various areas. It's going to be companies like FBN making investments, hopefully in the technology and the infrastructure and the operational components, but it's also going to be each person in that value chain from farmers all the way to probably grocery stores making similar investments as consumers start to demand these attributes. And so what all that to say is fairly long-winded way of saying that we are working to bring all of those component pieces together, try to define these solutions for, I'd say principally the food and beverage companies at the sort of the tail end of that value chain, so they understand where those investments need to be placed and ultimately what they're going to do long term. And so as we think about the evolution of this market generally, offsets play, we think, a critical role, or can play a critical role, especially in the short term, to drive investment, especially as policymakers are signaling a lot of interest here. But if you think about the long term of sustainability, it's really got to be embedded in the supply chain. It has to. That's where the staying power is. As we know, governments come and go, administrations come and go, corporations tend to stick around for a long time. And I think those investments that can be long-term investments are going to be most meaningful and have the most staying power. And so we are very much working on both sides, and we want to make sure that that optionality is there for farmers in particular.
Devin, one of the frustrations that we've heard from a number of progressive growers on this is that the pioneers in this space, ones that have really created regenerative practices, worked for 10, sometimes 20 years to perfect, cover cropping strategies, to pioneer the changes in tillage, reduction in tillage, are being excluded from the offset markets. And so you look around and you say, hey, I helped make this science. Why am I being excluded from incentives? What can you talk about how supply chain programs are actually going to incentivize those growers?
Yeah, well, talk to me about the comment that you made first a little bit. This sort of term of additionality, which I think is a bit of a four-letter word to some of those farmers who have made these investments over the last 2 decades. And what additionality means is effectively, as you're paying for some of these attributes, especially this is really important for offset markets, that you want to make sure that you're incentivizing an actual change that took place in real time. So you don't want to pay for a change that took place 20 years ago. Now, that's a critical component as you think about buying an offset credit. That if you're, if a global bank or professional services company, you want to be incentivizing or paying for a specific change in practice. The big benefit of the embedded supply chain programs, or again, what we like to call insets, is that it's more geared towards the emissions outcome of a particular farm. And so really evaluating where a farm sits in terms of their overall emissions relative to various benchmarks. And that could be a regional average or a national average. And what that means is it really benefits the farms that made those investments 10, 15, 20 years ago, because they're reaping the returns of that now. Their soil health is better. They don't need to use as many inputs to achieve the high level of yields they're likely seeing. And so I think that is a major distinction between these two types of programs. Offsets are really focused on the soil as a sponge, soaking up carbon and storing that, and really focused on additionality. Insets are really driven towards emissions reduction, long-term maintenance of emissions reductions, and rewarding farmers who have already made those investments in the past.
Great, fantastic. So, and you covered the additionality question that I had for you. Devin, you mentioned that there were emerging markets here from a regulatory side. I'm curious to know what you've seen from voluntary markets that make us confident that some of these, there's going to be demand here, and that also what we've seen from regulatory markets and how that might change in the future.
Yeah, I'd say I've had so many conversations on this topic in the last 4 months. I think the world has changed a little bit in this regard too. Today voluntary markets are quite small. The number we hear about oftentimes is $300 million globally. That might seem like a big number, but when you spread across the entire globe, that's actually a very small number. But I would say, a lot of folks are, I'd say, starting to invest more time and attention on that particular topic. You see this from major global investors like BlackRock, all the way down to smaller corporations who are thinking about their ESG goals, the environmental social governance goals as a corporation. How you think about things like carbon accounting and the commitments that these companies have. And I think last check I saw 1,200 or so corporations making net zero commitments over the next 1 to 2 decades or so. So I think it's a powerful trend. And what that means is if those commitments are actually being acted upon, let's say that those voluntary markets are almost certainly going to grow over time. The speed of which is always going to be difficult to say, but I think a lot of projections suggest that that's going to be substantial, in particular in the next decade. Compliance markets, as opposed to voluntary markets, I think have the ability to move very fast. For a voluntary market, it's going to be a bit of a slow roll, and momentum will build over time. You'll see kind of inertia. With compliance markets, obviously that requires a policy decision, and it's sort of more binary. Suddenly, a rule happens in the administration. The U.S. government passes a rule, or state governments pass changes in the existing practices, and the next day, new markets can come online. And so I think as we think, as I think about, and I think others I speak with think about the opportunity here, there's very much a role for governments to play here to help really drive short-term investment here. And I think, our stance is that it should really be on the incentive side, the carrot side of the equation, as much as possible for farmers to really try to drive incentive and provide, funding for those broader investments. And that can happen, I think, with things like the carbon bank that the administration has talked about, but also with state programs like low carbon fuel standards, which pose, I think, really interesting solutions for things like biofuels, which offer, I think, a big long-term opportunity for sustainability and transportation in particular.
Mm. So Devin, and this is the last question in our segment, but given some of the uncertainty around markets and how they are developing, can you tell folks why it's important to get started in a program today, and why it's important to select a project developer who gives you the optionality that the Gradable program has?
Yeah, well, I think there's kind of two aspects to that response. Again, with the kind of supply chain based inset programs, like I said, a lot of these investments require years to actually start to pay off in terms of kind of soil health and kind of the returns on fertility you'll see. And so thinking through what those investments look like now, even if they're not made, at least understanding, doing the research, I think is really important. On the offset side, as long as you're with the program that has the flexibility, like we've talked about, especially on the pricing side, I think it does make sense to start to generate those credits. It doesn't necessarily make sense to sell that credit because I think we all want to see how these markets evolve over time. And ultimately with the offset side, again, think about the sponge analogy as a reservoir. It's finite. You can't continue to soak up carbon into the soil forever. There's a limited amount. And so there'll be a limited amount of credit generation. And so I think what we want to arm farmers with in particular is the flexibility to think through how those finite set of credits can be marketed and sold and when.
Fantastic. Devin, thank you for providing some information on why optionality is important in these new carbon markets. I'm Steele Lorenz, Head of Sustainable Business. Thanks for watching.